The SpaceX IPO. Your retirement fund is buying this, whether you like it or not. SpaceX is burning through $4.28 billion in a single quarter. In 3 months. That's more cash than Disney makes in profit in an entire year. And the company just filed to go public at $1.75 trillion. A valuation so astronomical it would make it the largest IPO in the history of human civilization, eclipsing Saudi Aramco's 2019 debut. Worth more than every American defense contractor combined. Worth more than Apple was in 2020. So here's the question you should be asking. Who the hell is buying this? The answer, and I promise you this is not hyperbole, is you. Your 401k, your index fund, your Vanguard S&P 500 ETF sitting quietly in your retirement account. Because the rules of the game have just been rewritten, quietly, deliberately, and the result is that passive investors like you are about to become the guaranteed exit ramp for Elon Musk's venture capitalists. Let me show you exactly how this works. First, let's talk about what SpaceX actually is right now, because it is not what most people think. On February 2nd, 2026, SpaceX completed an all-stock acquisition of xAI, Musk's artificial intelligence company, valuing the combined entity at $1.25 trillion. That merger folded in X Corp, formerly Twitter, which xAI had already swallowed in an all-stock deal, valuing it at $33 billion, or $45 billion, including its debt. AI also snapped up Hotshot, the video generation company, and made a $97.4 billion bid for OpenAI that ultimately went nowhere. The whole thing was restructured on May 6, 2026 into a division called SpaceX AI. So what you're being sold as a rocket company is actually a conglomerate. Rockets, satellites, an AI chatbot with 1.9 million paying subscribers. A social media network, a supercomputer in Memphis. This thing is not Emirates. It is Emirates merged with Spirit. Spirit Airlines merged with a startup data center and a struggling Twitter clone. Now let's talk about the actual financials, because this is where it gets genuinely ugly. Starlink, the satellite internet business that actually makes money, generated $11.4 billion in revenue in 2025 and $4.4 billion in operating income. That is real. That is good. That is the cash cow. Then there's SpaceX AI. In Q1 2026 alone, the AI division lost $2.47 billion on revenues of just $818 million. For all of 2025, xAI burned through $6.36 billion in operating losses on revenues of $3.2 billion. The consolidated company, the whole thing, lost $4.9 billion in 2025. And in just the first quarter of 2026, it lost another $4.28 billion. Here's what makes that number even more alarming. In Q1 2026, SpaceX spent $10.1 billion in capital expenditures. In one quarter, nearly half of what they spent in all of 2025. And of that $10.1 billion, $7.72 billion, 76.4%, went to AI infrastructure. The rocket business that built this entire company got $1 billion. Starlink, which is the actual profit engine, got $1.3 billion. The AI black hole got everything else. The cash balance has gone from $24.75 billion at the end of 2025 to $15.85 billion by Q1 2026. At this burn rate, that's gone in less than a year. To paper over this, SpaceX took out a $20 billion bridge loan in March 2026 to refinance xAI's pre-existing $16 billion in high-cost private debt. So, SpaceX's balance sheet just absorbed xAI's liabilities. Corporate debt has ballooned from $16 billion to $29.1 billion in under 6 months. Their big revenue offset, a deal with Anthropic, a direct AI competitor, to lease 300 megawatts of compute capacity from the Memphis Colossus data center for $1.25 billion per month, $15 billion a year. That sounds incredible until you read the fine print. 90-day mutual termination clause. Anthropic can walk in 90 days. And the fact that SpaceX is leasing compute to a competitor tells you everything you need to know about how weak demand for Grok actually is. At $1.75 trillion, this company is trading at 92 to 100 times sales. NVIDIA, the poster child of the AI boom, trades at 24 times sales, and NVIDIA is profitable. SpaceX is losing $17 billion a year on an annualized basis and accelerating. Now here's the twist. The part most of the coverage is completely missing. It doesn't matter whether the valuation is rational, because the system has been engineered to force you to buy it anyway. Over 53% of all U.S. equity assets are now managed passively. Index funds and ETFs that are legally required to hold whatever the index tells them to hold. That's roughly $30 trillion. $27.7 trillion of it benchmarked directly to S&P Dow Jones indices alone. Here's what's changed. Index providers have quietly rewritten their inclusion rules specifically to accommodate mega-cap IPOs like SpaceX. FTSE Russell, eligible after 5 trading days. CRSP, which powers Vanguard's funds, 5 trading days. MSCI, 10 trading days, a rule they've had since 2017. NASDAQ 100, 15 trading days. And the S&P 500, which historically required a company to be public for 12 months before joining, proposed in June 2026 to cut that seasoning period to just 6 months, drop the 10% minimum public float requirement, and eliminate profitability requirements for large IPOs. Profitability requirements eliminated for a company losing $17 billion a year annualized. The SEC simultaneously proposed its own deregulatory package on May 19, 2026, expanding Form S-3 eligibility, creating new issuer categories, and relaxing auditor attestation requirements. The total effect is a system that has been systematically dismantled to make it easier, faster, and cheaper to dump a massive, unprofitable, newly public company directly into the hands of retirement savers. And here's the mechanical squeeze that follows. SpaceX is only floating 4 to 5% of its shares, somewhere between $75 and $87.5 billion of stock. About 30% of that is already pre-committed to retail platforms like Robinhood and Fidelity, so the institutional free float is paper thin. S&P 500 index trackers alone are projected to purchase approximately 19% of that public float within the first 6 months. Add the Russell 1000 and NASDAQ 100 tracking vehicles, and passive algorithms must buy up to 24% of the entire float. Include active managers who benchmark to those same indices, people who will be fired if they underperform. And you're looking at nearly 48% of the tradable float locked up in mandatory or semi-mandatory buying pressure. That thin float, that much forced demand, that compressed timeline. This is not price discovery. This is a mechanical buying event, and the hedge funds know this. Quantitative trading desks are already buying out-of-the-money call options and forward contracts ahead of the index inclusion dates. When passive funds are forced to buy, market makers have to hedge their options books by buying the underlying stock. This is called gamma hedging, which drives the price up further, which forces the passive funds to pay even more. Your retirement capital is the guaranteed exit liquidity for the venture capitalist who got in at $200 a share. JP Morgan estimates that if SpaceX ultimately floats 50% of its shares at a $2 trillion valuation, index funds will be forced to sell approximately $95 billion worth of Apple, Microsoft, and NVIDIA to free up capital. Companies at the bottom of the NASDAQ 100 get deleted to make room. The whole index reshuffles around one company's IPO. Here's what 30 years of data actually says about where this goes. University of Florida professor Jay Ritter has spent his career studying IPO performance. His conclusion, over a 3-year holding period, the average IPO underperforms the broader market by 23.4%, and the ones that come to market at extreme price-to-sales multiples. They fare the worst. Rivian debuted at over $100 billion with near-zero revenue. It's down 82%. Didi went public in 2021 and lost 74% of its value. Figma quadrupled on day one and is now 35% below its IPO price. 75% of the 50 highest valued IPOs over the last 5 years underperformed the S&P 500. An investor who bought every major IPO at offering price averaged 27% returns. An investor who just held the S&P 500 over those same periods averaged 53%. And SpaceX is being priced at 92 to 100 times sales. There's one more layer here that almost nobody is talking about. SpaceX has declared itself a controlled company under NASDAQ rules. Elon Musk will hold 85.1% of the combined voting power through a dual-class share structure. You, as a minority shareholder, have zero ability to influence strategy, capital allocation, or executive compensation. You are a passenger. You are not even in the car. Tesla has $2 billion invested in XAI, now converted into roughly 19 million SpaceX shares. In 2025, SpaceX and XAI collectively purchased $650 million of hardware and services from Tesla, including $506 million of Tesla Megapack batteries for the Memphis data center. The same directors sit on multiple boards, and when XAI needed to refinance its expensive private debt in March, SpaceX's balance sheet absorbed it. Contagion risk flows in every direction across this portfolio. Analyst Joe Gilbert put it plainly. The SpaceX YPO cannot be a positive for Tesla because it gives institutions a purer, more direct way to bet on Musk's technology vision, and capital will rotate accordingly. The feature that made passive investing simple and efficient for you, automatic, rules-based ownership of the whole market, is the same feature that makes you a guaranteed buyer for anyone who can engineer their way into the index at a $1 trillion valuation. And right now, the rules have just been changed to make that engineering easier than it has ever been. If you hold a market cap weighted index fund, SpaceX is coming to your portfolio. The only question is what price you'll be forced to pay for it. If this video helped you understand what's actually happening here, subscribe. We cover the mechanics that most financial media skips. And if you're thinking about your own exposure, drop a comment. I'll see you in the next one.